Welcome everyone. Thank you for joining this presentation on the euro to US dollar currency pair. Over the next few minutes, we will be conducting a comprehensive analysis of the euro versus the US dollar for the period of September 8th to 13th, 2025. Our goal today is to provide you with a clear and concise overview of the recent market dynamics, key technical levels, and potential trading strategies for this major currency pair. We will be drawing on data from some of the most reputable sources in the financial industry to ensure our analysis is both thorough and reliable. To begin, let's review the sources of our analysis and the current market price of the EUR/USD pair. We have gathered data from TradingView, investingLive, actionforex.com, and DailyForex. Please note that we were unable to access data from forex.com due to restrictions. As of September 15th, 2025, the current price of the EUR/USD is 1.17249. The pair has seen a slight daily change of minus 0.08%. The chart on the left provides a visual representation of the price movement over the past week, showing a period of consolidation after reaching a recent high. On the right, you can see a detailed breakdown of the current price information, including the previous close, the opening price, the day's range, and the trading volume. This data provides a snapshot of the market's current state and will serve as the foundation for our analysis. Now let's delve into the technical performance of the euro to US dollar pair. The table on the left shows the performance across various time periods. While the pair has experienced a slight dip in the last day, the overall trend remains positive, with gains of 0.15% over 5 days, 0.67% over the past month, and a significant 13.23% year-to-date. The bar chart below the table provides a visual representation of this performance, highlighting the strong upward momentum in the medium to long term. On the right, we have a summary of the technical indicators. Both oscillators and moving averages are currently in a neutral position, which suggests a period of consolidation. The radar chart below provides a more detailed breakdown of the various technical indicators, confirming this neutral stance. In this slide, we will examine the perspectives of leading financial analysts from investingLive, actionforex, and DailyForex. As you can see, there is a general consensus among these experts, although with some nuances in their analysis. investingLive highlights the significant impact of large option expiries and the market's pricing of 75 basis points in Fed rate cuts. actionforex, on the other hand, maintains a bullish outlook as long as the 1.1607 support level holds, with a potential retest of the 1.1829 high. DailyForex offers a more cautious, neutral stance, providing specific support and resistance levels to watch. They also offer both buy and sell signals depending on the price action. In summary, the consensus view is neutral with a bullish bias in the short term. The key support zone to watch is between 1.1607 and 1.1660, while the key resistance zone is between 1.1779 and 1.1829. Now, let's turn our attention to the key market news that influenced the EUR/USD pair during the week of September 8th to 13th. As you can see, there were several significant events that shaped market sentiment. The European Central Bank's decision to hold rates steady was a major event, though it was widely expected and had a neutral impact on the euro. More significantly, the US inflation data came in as expected, which reinforced the market's dovish outlook on the Federal Reserve. This, combined with the market pricing in 75 basis points of Fed rate cuts by year-end, provided a strong tailwind for the EUR/USD. On the right, we have some additional market commentary. ECB officials have been actively communicating, with some suggesting that the market may have overreacted to the latest policy statement. The divergence in monetary policy between the Fed and the ECB is a key bullish factor for the pair. However, the overall market sentiment remains cautious ahead of the upcoming Federal Reserve meeting. In this slide, we will take a closer look at the key support and resistance levels for the EUR/USD pair. These levels are crucial for identifying potential entry and exit points for trades. The chart on the left provides a visual representation of these levels, based on data from TradingView, actionforex, and DailyForex. As you can see, the pair is currently trading within a well-defined range. On the right, we have a detailed breakdown of the key resistance and support levels. The main resistance levels to watch are 1.1750, 1.1779, and 1.1800. A break above these levels could signal a further move to the upside. On the other hand, the key support levels are 1.1680, 1.1660, and 1.1607. A break below these levels could indicate a bearish turn. Based on our analysis, we have developed a short-term trading strategy for the EUR/USD pair covering the next 1 to 2 weeks. We have outlined both a long and a short strategy to account for different market scenarios. For our long strategy, we recommend entering the market between 1.1680 and 1.1700 with a target of 1.1780 to 1.1800. A stop loss should be placed at 1.1650, which gives us a risk-reward ratio of 1 to 2. For our short strategy, we suggest entering the market between 1.1800 and 1.1820, with a target of 1.1700 to 1.1700, 1.1680. A stop loss should be placed at 1.1850, providing a risk-reward ratio of 1 to 2.5. The chart on the right illustrates these entry and exit points, along with the projected paths for both the long and short scenarios. The key short-term event to watch is the upcoming Federal Reserve monetary policy decision, which could significantly impact the market. Now let's take a step back and look at the medium-term outlook for the EUR/USD pair, covering the next 1 to 3 months. We have developed 2 scenarios, a bullish scenario and a bearish scenario. Our bullish scenario, which we assign a 70% probability, is based on the assumption that the Fed will cut rates as expected, the ECB will maintain its neutral stance, and US economic data will continue to show weakness. In this scenario, we see the EUR/USD pair targeting the 1.1900 to 1.2000 range. The recommended strategy is to buy on dips, focusing on the 1.1680 to 1.1700 support area. Our bearish scenario, with a 30% probability, is based on a hawkish surprise from the Fed, a dovish turn from the ECB, or a sudden improvement in US economic data. In this case, we see the pair targeting the 1.1500 to 1.1600 range. The recommended strategy is to sell on rallies, focusing on the 1.1800 to 1.1820 resistance area. The chart on the right provides a visual representation of these 2 scenarios, along with the key factors to monitor, including central bank decisions, economic data, and political developments. Finally, let's discuss the risk factors that could impact our analysis and trading strategies. It is crucial to be aware of these risks and to have a solid risk management plan in place. On the left, we have outlined the upside and downside risks. The main upside risks include a more aggressive than expected Fed rate cut and continued weakness in US economic data. The main downside risks include a hawkish surprise from the Fed and a dovish turn from the ECB. The bar chart below provides a visual representation of the probability of each of these risks. On the right, we have an image that represents the importance of risk assessment in trading. Below that, we have some key trading discipline recommendations, including using strict stop losses, adjusting position sizes, monitoring news, and being flexible in your trading strategy. I want to emphasize that market conditions can change rapidly, and it is essential to trade cautiously and implement proper risk management strategies to protect your capital.